Hey there, Vinny from Project Frugal. Today we're going to be looking at the 4% rule, what it is, what it means, and how it's going to impact your retirement. Check it out. What is the 4% rule? Well, back in 1998, three professors from Trinity University over in the US of A created a study called the Trinity Study, and that represented how much money you could potentially take out from your portfolio and how long it would last. And the best number they came up with was 4%. This is an average amount of money that you could hypothetically carry on taking out of your portfolio for the rest of your life. So if you've got $1 million and you hypothetically took out 4%, i.e. $40,000, in theory, it should last the rest of your life. Does that make sense? Is it practical? Well, let's go and check out how you could invest this money and check out the difference between stocks and bonds. In order to be able to withdraw 4% from your portfolio, the first thing you need to do is create a budget and calculate how much your annual expenses are. In this case, we've got a few examples here. If your annual expenses were $20,000, it could be US dollars, could be Australian dollars, it could be Philippine pesos. Doesn't really matter. Then in that case, you would need 500,000 of that particular currency in order to generate $20,000. 20,000 of 500,000 is 4%. In our particular scenario, at the moment, our yearly expenses are $25,000. So our FIRE number for bare minimum survival, bare minimum living is $625,000. This means we need to save up at least $625,000 before we could realistically think about possible retirement. Over on the right hand side you can see we've got some calculated numbers, and this represents, based on 8% annual returns, how much you would have to save per year to reach this particular target. I.e. if we're looking at the $500,000, you would have to save $2,780 per month for 10 years in order to achieve $500,000. And this is assuming that you can get 8% annual returns. If your time period is a longer period, say you're looking at retiring in 20 years, then that number drops down dramatically. You'd only have to save $880 per month, but it is a long time, it's 20 years. And the power of compound interest will grow that money over time. So the longer you can leave the money in there, the earlier you can start, the less money you'll need to invest on a regular basis. If you look at our example where we need $25,000 a year just to cover our basic living costs, at this stage, if we were starting from zero and we wanted to do it in 10 years time, we would need to save $3,470 per month per year for 10 years. If you looked at that figure there, let's call it $3,500 times by 12, we're talking about $40,000 a year over 10 years. That's roughly $400,000 of our own money that we'd have to put in. With the power of compound interest and annual returns, in 10 years time, in theory, that should be worth roughly around $625,000. The earlier you can start, the better. We've left it quite late in the piece, but we've got to do what we can with where we're at. And the same will apply to you. Doesn't matter if you're 20 or if you're 50 or if you're 60. To cut a long story short, the longer the time period, the less you'll have to put into the portfolio, and you can let the compounding interest do its magic. If you wanted $100,000 a year, you're going to need $2.5 million. That is a lot of money. So investing $1,775 over 30 years is quite a large chunk, but it's possible it could be done. That's roughly just under $500 a week. It's a lot of money over a long period of time. There is a risk involved with taking your money at 4% over a long period of time. We can see on this particular chart here, if you invest purely in stocks, 100% stocks and 0% bonds, bonds normally pay out a lower amount than stocks. Bonds are issued either by corporates or by the government to raise capital for whatever they want to do, whether it's to pay off debt or maybe invest in some more stock or research and development, that sort of thing. Bonds, less risky than stocks, but they don't generally pay out as much. So there are inherent risks over the period that you want your 4% amount of your total portfolio, whether it's going to last the distance. And you can see on this particular chart here, looking at 5 years through to 70 years, the potential success rate of just purely investing in stocks and the chance that your money will survive that long. You can see here it starts off good, 100%, but the stock market is very volatile, goes up and down like a yo-yo, whereas with bonds, they're very stable, but over the long term, you're not going to have enough money to survive. But it depends what your time horizon is. If you're retiring at 65 and you expect to live to the average age of, let's say, 83, that's 18 years that you would need your money to survive. Will it do that? Well, it's up to you. It's your risk, it's your decision, and it's your strategy. And finally, this chart looks at the $25,000 worth we'd be taking out per year to cover our minimal basic expenses of $25,000 based on the current time. Obviously, these numbers are subject to change over the next few years. But if we manage to save up $625,000 and we took out $25,000 at the start of our hypothetical retirement, and we assumed that the money that was left in there was going to get a 7% annual return. This is purely on stocks, by the way. This covers the 4% that we take out, in this case $25,000. We've got $600,000. Assuming that increases by 7% over the following year, we'd be left with $642,000. Now this also takes into account inflation. Now inflation does go up and down. The annual returns could be negative, they could be positive. It essentially gives the best guesstimate, rough idea of how much you could actually take out and be okay. So the following year, you'd be starting with $642,000 in your portfolio. Obviously, inflation has increased the price of goods and services a little bit more. This time, you've now got $25,680 based on the 4% rule that you could hypothetically take out. And if we fast forward 20 years, your portfolio has actually grown to over $1 million. Obviously, $1 million in 20 odd years is not going to be worth what it's worth now, but you'd be taking out $42,760 essentially to cover what you're spending your money on now. And that's about all we wanted to say in this video, so thanks for sticking around. If you do the due diligence, you save up lots of cash. It's going to take a long time. It's certainly not a get-rich-quick scheme, that's for sure. Save all that money up. If you save up $1 million and you get the 4% every year from that, you get $40,000. If that's enough to cover your costs, great. If it's only $500,000, even better. So frugal living, yeah, that's definitely going to help. Catch you later and have a great night, morning, evening, wherever you are. See you later.